Alright, so here is what's happening, and nobody wants to talk about this. But we are sitting in one of the most volatile geopolitical moments in a decade. The US-Iran situation is escalating, seriously escalating, and I am not talking about headlines you skim. I am talking about real consequences for your money right now. Let's break this down. The Strait of Hormuz, you know where that is. That's where 30% of global oil trades every single day. 30%, and Iran controls it. They are threatening to block it. We have got oil spike by more than 26% to $90 per barrel in last few weeks. Our Nifty, our very own Nifty, the Indian stock market index, dipped 5% because of this. Because when oil wars start, equity market bleeds. But here is the thing most people miss. Your typical mutual fund. What about that? The one everyone's being dumping money into. They are getting absolutely crushed in this crash. But gold? Gold was up 84%. That's not a coincidence. That's the market screaming, guys, something is wrong, de-risk yourself, get into safe havens. And the longer story, over 2 years, these equity funds are annualizing at about 18%. Sounds very decent until you realize inflation ate half of it. Meanwhile, small cap funds are down 15% in just 6 months. Russia-Ukraine is still dragging. Sudan is in chaos. GPR, the global risk index, is up 40%. So what is actually happening? Wars typically crush cyclicals. They crush growth stock. They crush consumer discretionary. They boost defensive assets like gold and balance fund. And that is where we are going today. In the next 12 minutes, we are going to break down top 5 mutual funds that are actually thriving in this mess. We are going to talk about funds with 42 to 85% one-year returns, why each one is specifically built for this geopolitical movement, the exact metrics you should be watching, how to build a portfolio that does not panic when the world does. Let's go. So our very first fund is Quantum Gold Saving Fund. And we start with gold because we have to. Here is why. India imports 80% of its crude oil, 80%. We are dependent on oil flowing through the Strait of Hormuz. The second, Iran blocks that strait, which, let's be honest, is on the table. Inflation is going to explode and the rupee will get murdered against the dollar. Gold is not sexy, gold is not exciting, but gold is what central banks are holding right now. Central banks added 585 tons of gold every single quarter last year. That's not random noise, that's institutional money saying, we are preparing for instability. When oil shock hits, when inflation spikes, and when currency war starts, gold is the one thing that holds its value. It's not correlated to equity, it's not hit by interest rates the same way, and it is the ultimate I don't trust this environment trade. Let's get into the number. 1 year return of this mutual fund, 85%. Seriously, compare that to your stock portfolio and you will realize how much you are missing. 5-year annualized return, 27.6%. Expense ratio, just 0.25%. Incredibly cheap. Asset under management is 476 crore rupees and Sharpe ratio is 1.8, which means the mutual fund is having low volatility and solid returns, the golden ratio for your investment. Now compare it with MCX Gold itself, which was up 84% in the same period. This fund matches physical gold exposure while being liquid, tax efficient and easy to buy and sell. Will it be your whole portfolio? Definitely not. Should it be 10 to 15% of it? Maybe yes. It's up to you. Number 2 mutual fund in our list is SBI Gold Fund. Again, another gold fund. Now here is where the pattern gets very interesting. Ukraine war, February 2022. Everyone panicked. The stock market tanked. Gold went up 25% a day. We are literally watching the same story playing out again. Iran tensions are rising. Oil is spiking. Geopolitical risk is at decade high. History does not repeat it, but it rhymes. SBI Gold Fund is the institutional answer to this. It's been around longer. It's got more than 5,000 crore in asset under management, which means it's the fund that institutional money uses when they want to hedge against geopolitical risk. But here is something crucial most people miss, the rupee hedge. When there is global instability, the dollar strengthens. Let's get to the number. 1 year return of this mutual fund, 84%. 5-year annualized return is 20 to 27%. Expense ratio is just 0.35%. AUM of this mutual fund is more than 5,000 crore. This will be your boring hedge, which is exactly what you want from a hedge in this condition. Number 3 would be Motilal Oswal Nifty India Defense Index. Okay, so till now we have covered the world is chaotic. Let's get gold. But here is the flip side. Wars create opportunities. India's defense budget is rupees 6.2 lakh crore for financial year 27. And it's growing approximately 10% year over year. Not because we want war, because geopolitical threats are real. China and Pakistan in the neighborhood, and India is spending on defense. And here is what most people don't get. The spending creates massive corporate profit. Companies like HAL, BAL got government contracts worth rupees 2 lakh crore. मतलब years of guaranteed return, भारत के अपने exports targets are doubling. 50,000 crore target by the end of this cycle. War accelerate defense spending. Every conflict we see globally makes Indian policymakers more paranoid about indigenization. This fund literally tracks the Nifty India Defense Index. So you are buying directly into HAL, BEL and other defense plays. लेट्स लुक एट नंबर नाउ। इस फंड का एक साल का रिटर्न है 47% और एक्सपेंस रेशियो सिर्फ 0.30%। इस फंड का AUM है 3700 करोड़ रुपए और ट्रैकिंग एरर लेस देन 1%। इट डज व्हाट इट सेज। इज इट रिस्कियर देन गोल्ड? डेफिनेटली यस। इट्स द सेक्टर दैट बेनिफिट्स विद द वॉर व्हाइल एवरीवन एल्स इज पैनिकिंग। नंबर 4 ऑन आवर लिस्ट, HDFC Defend Fund. Now the difference here is subtle but important. The Motilal Oswal fund was passive, it tracks an index. You get exactly what the index gives you, ना ज़्यादा ना कम। HDFC Defense Fund एक एक्टिव फंड है, यानी फंड मैनेजर इज एक्टिवली पिकिंग विच डिफेंस कंपनीज टू बाय एंड राइट नाउ दे आर बैटिंग हेवी ऑन आत्मनिर्भर इंडिजिनियस वेपन। हियर इज द जियोपॉलिटिकल रियलिटी। यूएस ईरान टेंशंस का मतलब है सप्लाई चेन डिसरप्शंस आर कमिंग। इंडिया कांट रिलाई ऑन यूएस एंड यूरोपियन इक्विपमेंट सप्लायर एनी। इट टेक्स टू लॉन्ग टू कम एंड टू मेनी अप्रूवल। So the government is aggressively pushing Indian companies to build indigenous weapon, missile, drone, everything. The government procurement backlog is rupees 2 lakh crore. ये वो government contract है जो already approved है. War accelerates these approval. Companies that can deliver fast move to the front line. HDFC Defense Fund is actively overweighing on these companies that are best positioned for this indigenization push. Now just look at the number. इस फंड का एक साल की रिटर्न है 42% और एक्सपेंस रेशियो 0.68%, जो शायद थोड़ा हायर साइड पे बिकॉज ऑफ एक्टिव मैनेजमेंट। नाउ द क्वेश्चन अराइजेस, इज द हायर एक्सपेंस रेशियो वर्थ इट? दैट डिपेंड्स on whether their stock picks beat the index or not. Recent history definitely says yes. Now number 5th fund in our list, ICICI Prudential Multi-Asset Fund. Here is what we have done so far. Pure gold defensive plays, pure defense sector offensive plays. But the smartest portfolio don't choose, they balance. This fund is what it's called, balance or multi-asset fund. The allocation will surprise you. 40% into equity, which signifies growth, 30% into debt signifying stability, and 20% in gold and commodities, which signifies hedge. Balance 10% in money market, which is why this fund is brilliant right now. During past wars and geopolitical crises, for example, Ukraine, COVID, etc., oil shock hit hard. Inflation spiked by 19% in 3 years. Raw commodity prices went like crazy. A fund that has both equity exposure and commodity hedges doesn't get knocked out easily. If oil spikes and cyclical stocks crashes, your gold and commodity holdings go up. If oil stabilizes and growth resumes, your equity allocation captures the upside. You are not betting your farm on one outcome. For people who are like, I don't know what's going to happen, I just know it's going to be volatile, this is the right answer. Now let's look at number. 1 year return 13%, lower than gold or defense, but that is intentional. In 5 year annualized return 19%, expense ratio of 0.75%, which is reasonable for active multi-asset management. AUM is 83,000 crore. Sharp ratio is 1.2 only, which signifies solid risk adjusted return. It ranked top in its category for balance fund last year. Boring might sound, but boring is what you want when the world goes crazy. Now the question arises, how to actually use these 5 funds? Alright, so we have got 5 funds. How do you actually use them? Here is the framework. For the conservative one, if you hate volatility, 30% each in quantum gold and SBI gold, comprising 60% of portfolio in defensive gold. 20% in ICICI multi-asset, signifies stability and some growth. 20% in cash or debt fund. This portfolio will not make you rich fast. It will not get destroyed if Iran blocks the Strait of Hormuz tomorrow. That's the trade-off you are taking. For the balance one, the middle ground one, 25% in gold, 35% in defense fund, 30% in ICICI multi-asset fund, and 10% keep in cash. This will be closer to your normal returns with geopolitical hedges. You are not panicking if market crashes, but you are still capturing when they rally. For the one who are very aggressive, if you think chaos is an opportunity, just take 10% in gold funds, 50% in defense fund, and 30% in ICICI multi-asset, and another 10% as regular equity funds, for example Nifty 50, etc. You are betting that defense stocks outrun the chaos. Riskier but higher upside. Now the critical part, how do you enter? Don't dump rupees 10 lakh into one fund today and panic when it drops 5% next week. Use SIP, systematic investment plan. Invest rupees 10,000 every month into each fund. This way, you average your cost across different price points. You don't cash the absolute top if market run up. You build position gradually as the geopolitical situation unfolds. You have time to see which funds you actually like. The difference between dumping it and going for SIP, it's usually 8 to 12% in your favor. And it feels better because you will not watch your money evaporate on day one. Now, let's be real about what could go wrong. The biggest risk is oil stabilization. If the Iran situation suddenly de-escalate, and I mean it could happen any day, oil drops back to $70 per barrel, gold loses its safe haven premium, defense stocks cools off, and your portfolio gets knocked sideways. Risk number 2, interest rate shock. If the Feds cut rates and everyone suddenly wants to buy growth stock again, defensive asset will look stupid. Gold could sell off hard. Your multi-asset fund underperform. This is actually happening right now in the US. Here is the thing about geopolitical timings. You can't predict the exact moment when you should enter the market. Right now, in the current time, we have got Iran-US escalation, oil dependency, defense budget increasing, gold holdings by central banks are at record high. These are not predictions, these are facts on the ground. 2 years from now, if nothing bad happens, you will look back and think, why did I put money in gold and defense stocks? But 6 months from now, if tension escalates, you will be the one person whose portfolio held up while everyone else was panicking. That's the asymmetric bet. Small downside if you are wrong, large upside if you are right. And frankly, given current geopolitics, the odds feel tilted towards being right. This is not a financial advice, I'm not a licensed advisor. But this is logical positioning given the geopolitical movement we are in. Don't panic, don't sell everything, but don't sit in regular equity funds and hope for the best trade. War-proof your portfolio, build resilience, get the 5 fund running right now. The next 6-12 months will tell us if this thesis was right, and I think it will be. Thanks again for watching. If this helped, smash that subscribe button, leave a comment and let me know which fund you are going into first. We will probably do a follow-up on this in 3 months once we see how the Iran situation actually plays out. Till then, thank you.